Welcome to Make Your Money Matter. I'm your host, Brad Barrett, and on this show, we aim to change the way you think about money so you can have a better relationship with your money. And today on our show, we're going to talk about how you should be thinking like Warren Buffett. Let's be honest, everyone likes a profitable business, right? But no one has invested into profitable businesses as well, in my opinion, as Warren Buffett. So we're going to talk about that today. But before we get started, make sure to smash that subscribe button, hit the notification bell so you don't miss a single episode. All right, let's get into it. Okay, so as a diligent investor, and I hope you're listening right now because we feel that we are at One Capital Management, but I want to share this across the board here as portfolio advisors. We want to look at a mix of things, right? Of both value and growth, especially within companies. And to me, I've talked about many different ways to value a company, but there's two that breaks down, I think, how Warren Buffett actually looks at investing in a company. And I'm going to call it the dynamic duo. The dynamic duo of investment analysis, okay? You like that? Fun little spin for the day. I'm going to focus on two, the return on invested capital, otherwise known as ROIC. You've likely seen that acronym. And the second one is return on equity, ROE. Now, I think it's really important to make sure that we understand that these two metrics, the first thing you're going to ask here is which one is better, Brad? Look, here's a quote I think from Warren Buffett himself that I think matters for that question. A truly great business must have an enduring moat, in quotes, that protects excellent returns on invested capital. Now, while reading Buffett's letters to shareholders, I've noticed in the past that he often talks about return on invested capital, and there are a few mentions of ROE. So that's why I think, return on equity. So I thought I'd discuss both of them because that's how he sees it. So let's break it down. Let's start with return on invested capital. First off, I'm going to go through a couple of questions here on each one of them, okay? Question that I think is important here are going to be like, how does it measure? Question two will be, how is it calculated? The third one is going to be, how is it manipulated? Because you can manipulate numbers, right? And the fourth is, what's the benchmark? I think the fifth and final one I'll go through is probably most important when we talk about how he uses it. So the first question I want to ask, regarding return on invested capital is, what does it measure? So ROIC measures how effective the business is at making money, period, end of story. That's why it's kind of the GOAT, if you will. Now, on equity, that is measured by how effective the equity is deployed. So it's very different. Now, the second question I'd ask here is, how is it calculated? So return on invested capital is calculated by taking the net operating profits after tax. In the accounting world or in the investing world, we see this acronym is called MOAT. So the net operating profits after tax divided by the invested capital. That's how you get the return on invested capital number. Now, the calculation for return on equity is the net income divided by the equity. So it's a different calculation there. Okay, third question I'm putting here, and for context, I think it's important, right? Is how can it be manipulated? There's a lot of ways in the accounting, world and where you can kind of take a look at something and it can be inflated or deflated depending on the inputs that you're putting into the calculation for return on invested capital. The answer is no, though, really. It can't really be manipulated, which is why I think Buffett always uses that as his moat, if you will, to protect the assets he's invested in. Now, switching gears, the return on equity, for example, you can inflate or deflate certain things, that income or how you got to that number when you divide it by equity. So the other question is, what's the benchmark here, right? How do I measure this from a benchmarking standpoint? The benchmark, I think, is really important in terms of, okay, great, Brad, you can calculate it, but how do you measure it? Success, right? So when you talk about how it's measured for ROIC, is how effective the businesses are making money is calculated by understanding that net operating profits after taxes, right, divided by invested capital. And to get the measure here, we want the weighted average cost of capital, which, by the way, is the rate that a company is expected to pay on average to all of its security holders to finance its assets. We want that weighted average cost of capital to be less than the return on invested capital. That equals the dollar amount of the benchmark that would make sense for that company, right? The return on equity, though, the benchmark there is the cost of equity, right? The actual cost of having the equity needs to be less than the return on equity, right? That makes sense. If the costs are less than what it is, then you have a profit. You have a good investment, okay? And the last one is the question, does Buffett use it? So I think this one, I like the question. I threw it in here at the end because we know likely if you've been watching and listening here today, he does use it. The answer is yes to that question on the return on invested capital. Now, many know the ROE, which is why I brought it up here to compare the two on return of equity. He only uses that for banks. I think that's interesting to note. So with that said, I thought it might be interesting to get in the mindset of Buffett so you can kind of see how he invests in things. And remember, He says a truly great business must have an enduring moat that protects excellent returns on invested capital. So I think the return on invested capital equation makes sense as you're looking into your investing strategy or speaking with your advisor about that. Hey, I hope you enjoyed that today. If you did, make sure to subscribe to our show so you don't miss a single episode. And always remember to make your money matter.